Same salary, same city, same $50,000 saved. One buys a rental property, one buys index funds. 20 years later, both are sitting close to $1 million. One of them is exhausted. And before you decide which one you're rooting for, I already know which one you picked. You picked it before you clicked on this video. That's fine. I did the same thing. The person who picked real estate ran the rent calculation and stopped. The person who picked stocks heard the word compounding once and called it done. Both built a spreadsheet that agreed with them. Both are currently very confident. This video is the part of the spreadsheet both of them skipped. Not because they're bad at math, because the feeling came before the math. And when a feeling gets to the numbers first, the numbers never really had a chance. That's the calculation error. Stick around. Okay, I want to say something that might sound weird coming from a finance channel. I understand why people pick real estate. Not just logically, I actually get it. There's a moment when you get the keys to a property. You walk through it alone for the first time. No agent hovering, no seller watching your face, just you. And something happens that no brokerage account confirmation email has ever produced in the history of financial services. You feel like you did something real. Your index fund does not have a kitchen you can stand in. It does not have a front door you can paint a color you actually like. You cannot text your parents a photo of your index fund and watch them look proud for the first time in recent memory. Real estate wins the feeling contest, and it is not close. And that feeling is not irrational. For most of human history, land meant security. Land meant survival. Your brain was built for this. It just hasn't received the update that says you can now own fractional shares of 4,000 companies from your phone in 40 minutes. The brain is still out there looking for something to stand on. But here's what that feeling quietly does to your math. When an investment feels like home, literally, you stop counting the same way. You count the rent check on the first. You do not count the Saturday in February you spent on a roof because the contractor said 3 weeks and you decided you'd just handle it. You do not count the month where your tenant, let's call him Ryan, stopped answering texts and you had to figure out the eviction process on your phone at midnight while also having a full-time job. Ryan, for the record, left the place with a hole in the wall and a deeply personal interpretation of what a security deposit is for. The feeling rounds up on the rent check. The feeling loses the receipt for everything else. And look, stocks have the opposite problem. A number that drops 30% in a month and doesn't feel like anything except low-grade dread every time you open the app, that's not a strategy. That's a character test most people fail quietly and never mention. Both of these investments have a psychological cost that never shows up in any calculator. You've been paying it without knowing it has a name. All right, numbers. This is the part where I'm supposed to show you a spreadsheet and you're supposed to feel informed. Bear with me. $50,000. You've saved it. It's sitting there waiting for you to do something that'll make a good story later. Option 1. 20% down on a $250,000 rental property. 30-year mortgage at 7%. Monthly payment around $1,300. You find a tenant at $1,800 a month. $470 a month profit. Sophia feels like a genius. Her friends agree. Someone brings it up at brunch. Let's keep going. Past the brunch part. Property taxes, around $3,000 a year. Insurance, $1,500. Maintenance, budget 1 to 2% of property value annually. That's between $2,500 and $5,000 a year on a $250,000 property. Good year, that's a faucet. Bad year, that's a furnace in November. The furnace does not care about Sophia's cash flow projections. The furnace just stops working and hands her an $8,000 invoice and waits. 1 month vacancy per year, the actual average. $1,800 gone. Mortgage still runs that month. The mortgage always runs. And her time. If she hires a property manager, 8 to 10% of rent. Gone before she sees it. If she manages it herself, she now has a second job. It doesn't have an HR department. It calls at 10 p.m. It does not observe public holidays. After all of that, the real cash-on-cash return on a rental property in an average market is somewhere between 3 and 6% annually. Not $470 a month, 3 to 6%. Sophia didn't make a bad investment. She made an incomplete calculation. She stopped at the rent check. Everything after that was inconvenient, so it quietly didn't happen. I've watched smart people do this more than once. Option 2. Same $50,000 into a total stock market index fund. $300 a month automatic contribution. About 40 minutes to set up, including the part where you can't remember which email you used to sign up. Year 1, roughly $55,000. Year 7, somewhere around $135,000. Year 20, north of $400,000. Total contributions over 20 years, around 120,000. The rest is compounding, doing the thing compounding does when you have the discipline or the indifference to not touch it. Marcus tells his coworkers what he's investing in at lunch. They nod. Someone brings up fantasy football. The conversation moves on. Marcus goes back to his desk. But I'd be doing exactly what every stock market video does if I stopped there. 2008. Market drops 37%. March 2020, 34% in 5 weeks. If Marcus had $150,000 and watched it turn into $95,000, that is not a number on a screen anymore. That is a Sunday morning. That is mental math that doesn't add up. That is a decision made at the worst possible time for the worst possible reasons. Most people sell at the bottom. The math says hold. The brain says get out. The brain almost always wins. Marcus's real return isn't the chart. It's the chart minus every panic decision he made while being human about it. Both investments have hidden costs. Real estate hides them in maintenance logs and stolen Saturdays. Stocks hide them in the gap between what the market returned and what the investor actually captured. The million-dollar question is not which one wins. It is which hidden cost you are actually equipped to pay. Quick interruption. If you are currently doing math on your own situation in your head, that is the entire point of this channel. Subscribe if you want more of this. The button is right there. I'm not going to make a whole production out of asking. Like the video too if you want. The algorithm apparently requires it. I don't build these systems. I just exist inside them. Okay, back to your $1 million. Here's something most real estate versus stocks videos will never say because it makes the whole debate sound less exciting. This isn't real estate versus stocks. It's leverage versus liquidity. And most people making this choice have never heard it framed that way because leverage versus liquidity doesn't get 4 million views. When Sophia put $50,000 down on a $250,000 property, she didn't invest $50,000. She controlled $250,000 in assets with $50,000, 5-to-1. When that property appreciates 4% in a year, Sophia isn't making 4% on $50,000, she's making 4% on $250,000, $10,000 in appreciation on a $50,000 entry. That math is real. That is the actual reason real estate builds wealth at a speed straight stock contributions can't always match early on. Not because bricks are magic, because borrowed money amplifying your returns is the closest thing to a legal advantage personal finance has. But leverage doesn't know which direction you want it to go. When the property drops, and markets always drop, Sophia's losses are amplified too. And unlike Marcus, who can close his app and wait, Sophia has a mortgage. It runs on the 1st, every month. When things drop and she has a vacancy at the same time, Marcus is uncomfortable watching a number. Sophia has a real problem with a real dollar amount and a real deadline. And then there is liquidity, the thing nobody thinks about until the exact moment they need it desperately. Marcus can sell tomorrow, any amount, in an afternoon. Job loss, medical emergency, he has access. Sophia's wealth is inside walls. To access it, she either sells, months of process, 6 to 10% in transaction costs, or she borrows against it, more debt on top of existing debt. There is a specific financial stress that comes from being wealthy on paper and cash poor in practice. It shows up at 2 in the morning when something goes wrong and the math doesn't move fast enough. And one more thing that never makes it into this conversation: concentration risk. Marcus is spread across thousands of companies. One fails, he doesn't notice. Whole market drops, he waits. Sophia's net worth is inside one building, one neighborhood, one city. If that neighborhood changes, factory closes, school district shifts, her asset changes with it. Concentration can make you rich fast. It can do the other thing too. It doesn't ask first. The real estate side says leverage is the answer. The index fund side says compounding is the answer. Both are right about their own investment. Neither mentions the full cost of what they didn't choose. The actual answer, and I realize this is not what you clicked for, is that leverage and liquidity are different tools. The mistake is picking the tool before you understand what you're building. So, which one gets you to $1 million faster? Honestly, it depends. Market, timing, location, discipline. Anyone giving you a clean, universal answer is selling something, probably a course, countdown timer included. But here is what I actually want you to leave with. The right question was never which investment wins. The right question is, what calculation did you run before you picked? Sophia walked through a property, felt something, and went looking for numbers that confirmed the feeling. Numbers will always cooperate if you're the one selecting them. That is not analysis. That is a conclusion looking for evidence. Marcus heard compound interest explained once, decided that was enough, and set up an account and tried not to look at it too often during bad months. Close to the right strategy, not quite. The error, the actual million-dollar calculation error, is that most people calculate what they want to own, not what they want their money to do. Those are different questions. They have different answers. And I'd bet a reasonable amount of money that you have never actually separated them in your head. Real estate answers, what do I want to own? Stocks answer, what do I want my money to become? If you have never sat with that difference, you have been running the math in the wrong order. Doesn't matter how clean the spreadsheet is, wrong question at the top means wrong answer at the bottom. Figure out what you want your money to do, then decide what to own. Run that calculation first. That's it. That's the whole thing. Sophia hits $1 million eventually. So does Marcus. Sophia worked for hers. Weekends, tenant calls, a furnace in November she didn't budget for, one eviction she no longer brings up at dinner. She got there. It cost her things that don't appear on any balance sheet. Marcus waited for his, through 2 crashes and 3 years where the number went sideways and he kept the contributions running anyway. Neither of them is wrong. Both of them made the same mistake. They decided before they calculated. The feeling walked in first. The spreadsheet just came along to agree. Most people watching this will do the same thing. And if that bothers you a little, good. That's the point. This is breaking money. See you in the next one.